Hey, what's up? I'm Hardik. I'm a senior in high school, and today we're gonna walk through a DCF. We're gonna be valuing Tesla, and the reason I'm making this is because every time I look out for a tutorial on DCFs, it's always been assuming a set of things that need not be assumed. So I get assuming tax rate, I get assuming perpetual growth, but then assuming the value of the free cash flow, assuming all other stuff. We're not going to do that. We're going to build our model from scratch, right? And I want to walk you through it while we do that. So, ideally, you should be seeing my screen right now, and we're going to be valuing Tesla. Let's get it. Awesome. So I've got the Excel sheet open. We're gonna value Tesla. Let's do that. Ideally, Excel would have recognized Tesla, but if not, it shows up here. Let's just slide this down. Awesome. Right. So had Tesla been another geography, we would have needed a currency conversion. We don't need that really right now because Tesla, of course, is a US company. Now the DCF this template I'm going to be sharing with you. Now this goes through every single aspect of what you need to do in DCF. I think this is a little excessive, but since I wanted to understand the nitty-gritties of how to get to where you want to get, rather than assuming some stuff from the get-go, this is how I built it. You're going to be able to access it in the description below ideally, or you can just drop me a DM and we're gonna make that happen. Awesome. Tesla. So this is the prerequisite. Now let's go to Tesla's SEC filings. Right. I can't spell. Uh, let's go through Tesla's SEC filings. Right. So what we're looking for is the 10K reports, which is the annual SEC filing for 3 years, 2024, 2023, 2022, 2021, and 2020, 2019, right? So how that works is we're gonna need 6 years. If you check this, we're gonna need to calculate the net working capital. We're gonna need 6 years of data, and those 6 years would since the balance sheet only accounts for 2 years at once, we're gonna need two, which is 3 years of disclosures, right? That makes sense. Let's go through a 10K. Do we have a 2023 10K? Right, this is the 10K. I'm gonna open this in a new tab. Then we're gonna need 2021. Right, apply filter. This is the 10K. Then we're gonna need 2019. Let's apply that filter as well. Does it load? Awesome, got it. Bruh. Yeah, that's it. It opens. For the fiscal, nah, this is not it. Let's open that again. Hopefully this will work this time. We need 2019, right? Apply filter, and we need the annual and quarterly reports. Cool. Awesome. So this is for this works. This is for December 31, 2018. Then this is for 2020, which is 2021. This is for 2022, which is 2023. Right? What we can also do, rather than taking this, you can also take for the years of 2024, 2022, and 2020, right? That would make more sense. But usually companies don't, since I'm not really sure when Tesla has its annual reports, earnings, right? So October 2024. So when that happens, you can take its annual filings, but a lot of companies, they usually don't file that early, so you're gonna have to wait a little while. Right. So this is for December 31, 2023. So for a company that files later than that, you'll not be able to find 2024 report. So we're gonna let's just do that then. Let's go with 2022. I'm gonna close all of these tabs. This is 2024. We're gonna keep that. Then we're gonna close all of those. Awesome. Then go to 2022. Then we cover 2020. Budget. Makes sense. Let's go. Cool. So let's just start with the 2024 sheet. This should be pretty quick. We're gonna let's have a look at what we're assuming right now, right? So the boxes in yellow is where we'll have to input stuff. The rest of the things will be calculated ideally, but they're gonna have to be times at which we're gonna edit stuff. So let's just keep that in mind. The current share price, we already have that. Let's get that from Excel itself. That's stocks, right? Awesome. Now this market cap we already know is stocks stocks B18 dot market cap. Does that work? Right, and then we're gonna divide this by 1,000. Sorry, a million, because Tesla gives out its earnings in millions, right? So let's just check that assumption. For a company of the scale that Tesla operates in, I'm pretty sure it discloses its stuff in the millions. So let's just check that once again. We have to go to 46, right? Yeah, dollars a million, awesome. Yeah, so we have that divided by million. As you can see, we already have the shares outstanding calculated for us. We're gonna look at Tesla's effective tax rate. Let's see if it discloses that. It does. It's minus 50%, right? So that's awesome for us, to be honest. This is the first company I've valued that does that, but I'm not surprised. Let's just have that percentage. Perpetual growth rate, that's with the GDP growth rate of the US, which is 1.9%. So we're gonna go with that. Market value of equity, which is just the market cap of that company. We're gonna go through the interest expenses. Yeah, interest expense, which is 156 for the latest year, so we're gonna go with that. And notice how I did not that negative, because when you file that out, you'll want to deduct that from the income that you're getting, since it's an expense. But since you're calculating the market value debt, you really need to add that on to debt, because of course interest expense is something that is being added on to debt. You needed to calculate the interest rate as well. So we're not going to deduct that, we're going to add that on to the market value debt measure. Right, let's see if total debt is disclosed. It is not disclosed often, even though Tesla is being especially kind and giving us it on a platter. But had it not been disclosed, we would have used this allocation. So this would have gone like we're gonna go with category. We're gonna go with value. This would be short-term debt. This would be long-term debt. Right, let's just command I that. This would have been short-term debt. Let's just do that. Why don't we? Short-term debt. I could have just looked at the balance sheet, but at this point, let me just do that. Yeah, finance leases, right? Current portion of the debt, which is 237 something. 37, what's that? 2373. Cool. And do we have any other form of debt? Long-term liabilities. We're not gonna add that on to this. Actually, we are gonna add that onto this, because I think what Tesla did was it disclosed its short-term carrying value of debt, which is not what we need. We need the total debt to the company. So let's just add that. I'm gonna sum this up. Right. Awesome. This should work ideally. Rather than this being our total debt, we want this to be our total debt because this is a more accurate measure. Net carrying value is not as accurate. Excuse me. It's not that accurate because it does not account for long-term debt and liabilities, right? Right. So this is on me. I looked at the total recourse debt and then find out the total debt from here, which is not how it works. Awesome. We dodged a bullet there. Cool. We're done with this section. As you can see, we'll have to import the CAPM and we'll have to import the weighted average maturity rate. Awesome. We've got that. We're now going to go with the weighted average maturity and the capital asset pricing model. Now, the weighted average maturity is relatively simple because it's given in the financial disclosure usually. And there's a way to calculate that. We're going to calculate that. It's not usually given as such, but there's a way to calculate that. The thing with CAPM is that it's not given anywhere in a company's filings, nor would you find it usually in in a pricing model or a financial a framework such as Yahoo Finances. So what we're going to do is I'm going to put on screen somewhere here what the formula for CAPM is, and I'm going to explain what it is. So a CAPM is a percentage where it basically looks at the correlation of a company's finances with that of the market. That market is assumed to be Nasdaq on the S&P 500, and we're going to take the risk-free rate. The risk-free rate is considered to be the rate at which a T-bond, a 10-year bond of the US Treasury grows at, and the market returns from that. So here's the model. We're going to look at the risk-free rate plus beta, which is the correlation of a company with the market, multiplied by, and this is in brackets, multiplied by the market return minus the risk-free rate, right? So you're gonna see that, excuse me, you're gonna see that on your screen, hopefully. And if you don't, that's on me while editing, but I hope you get what it means. So it basically shows the rate at which equity is expected to grow, right? So that is what we're getting at. So we already have the weighted interest rate, which is the cost of debt in the calculation for weighted average cost of capital, but the cost of equity is where CAPM comes in. It's relatively simple, but still, if there's any confusion, I'll be happy to clear that up in the thing, right? Awesome. So let's just, I'm going to show you how to calculate CAPM first. I have this model here. I built this in R. So what it does is it's a modern portfolio theory implementer, but that's a video for another day. What we're going to do currently is calculate the beta and capital asset pricing model for Tesla. Right? Let's do that. Let's do that. Right. So this is the beta. The beta basically tells you its correlation with the market. So a beta of 1 shows that when the market grows by X percent, Tesla would also grow by X percent had it been a beta of 1. Since it's a beta of relatively 1.5, somewhere around 1.5, that basically says that if the market grows by 1, Tesla is expected to grow by 1.5x. But if the market drops by 1, the company Tesla is expected to drop by 1.5, right? A company which is -1, which has a beta of -1, would drop by X every time the Nasdaq or the S&P 500 would increase by X, and vice versa. So, right? So that is what beta is. And the calculation for beta is right here. This is the CAPM, the calculation for CAPM is right here. So this is what the CAPM does. We look at the multiplier, which is the market returns, which we've calculated through this ETF, which combines the S&P 500 and looks at their returns, and this is the risk-free rate. The risk-free rate is given if you just look for the T-bond returns on Google, 10-year T-bond returns, you'll find a 3.7% number, and this is what that is. So the risk-free rate is 0.037, which is 3.7%, right? So that makes sense. CAPM then is just beta plus multiplier plus RM. So this is a multiplier, and this is the market returns. Cool. So this is what we get. The CAPM is 23% for Tesla. Let's put that in. Let's plug that in. How much was it? It was 23. Cool. Okay, let's now look for the weighted average maturity. Now, how we calculate that is varies from company to company. So what I'm going to do is, awesome, we already have it here. Right, so this is what it is. What the company has given to us, its leases for the coming years that it has a obligation to pay off in due time. And so these years and these values, we'd add that up, and we look at the average maturity of all of these leases, right? The weighted average maturity. So since I'll just give you an example. Since we're gonna look at 2025, for example, 2025 has it's been an year since this financial form came out, and 2025, right? So 1 year, and its operating plus financial lease is somewhere around 912. Excuse me, 912. So we're gonna add that, multiply that by 1, and divide it by this this number, which is 5360, and that is one fraction that we have. Now we're going to repeat that process for 2024, 2026, 2027, 2028, and thereafter I personally like to take thereafter to be 10 years. So we're going to assume that this maturity goes up till 2024, and that is when thereafter ends. But you're free to assume this to be 15, 7, 8, 9, right? But take into account that since 2028 is the last disclosed year, so it must not be 5 or something like that, because that is not big of enough of a difference to account for thereafter. Awesome. Let's plug that in. Right here, so we're gonna keep year, we're gonna keep value, we're gonna take years since 2024, and that should be approximately it. Let's just commodify that. The year is 2024, we have 2025, 2026, 2027, 2028. Let's just option touch that. We've got thereafter. Cool. And let's just reduce the formatting here. So what I'm going to do instead of this is, rather than option F4 this, I'm going to just command X this, because I have this thing where I feel like if I option select this, then it displaces the cells, while command X does not do that. So I prefer doing that, but I'm not really sure if that is actually true or if just the fear that I have. But I'm not gonna try to beat that fear today. We're gonna go with that. Yeah. But if you want to try that, go ahead. I mean, I support that. Let's just do this minus 2024. Right, so Command D, Control D rather. And since we have operating and financial leases, let's just, rather than making it value, why not just make that operating and financial lease separately. So we've got operating leases, if I'm not wrong. Is that it? Yeah, and finance leases. Cool. We've got 892. I'll just fill this in quick. 892, 831, 706, 603, 706, 603, 508, 1820. Cool. Finance leases 418, 81, 5738, 4 and 2, 2 and 4. This I'm gonna hard code it to be 15. And we're gonna do some product. Let's just do some first, and then some. Wait, can't I do that? I think there's gonna be a problem there. That's fine. Is it fine though? No, we're gonna run into a problem there. Let's just alt tab that as well. And then why do I alt tab this? Let's just command exit. That looks better. Then rather than this being here, we're gonna do a sum total releases. I know this is a little, this is not uniform. This will change from company to company, but that's the whole point. If you want to do it from scratch, if you want to do it without taking any, haywire assumptions, that's how it's gonna be. So we're gonna need to do that. What I'm gonna do is sum this and this. Then I'm going to command D that, and then I'm going to sum product that. That should work. Yeah, and then we're going to divide this by the total value which we've got here. That should give us the average maturity. Let's just look at that. Yeah. And now we've got our weighted average cost of capital. Now you can of course configure this weighted interest rate however you want. To be honest, I think this is a bit of a sham because the weighted interest rate just comes from the interest expenses divided by total debt. So it is a cyclic formula in itself. So I don't believe this number. Let me just go with 3% and let's see what happens. Right, so we've got a minute change. Let's just go with 2%. Yeah, that sounds a little more sensible because 1.5 to 2%. That's tolerable, right? Let's just assume that. Cool. Now we're gonna move through this column and these columns. So how they work is, now this is where the financial statement parts of things come in. I'm gonna tell you what I'm gonna do. What we're gonna do is I'm gonna fill out this section of the Excel, which goes EBIT, cash taxes, DNA, property plant and property plant expenditures, or capex, capital expenditures, net working capital, which is total assets, current assets plus current liabilities, minus current liabilities, and then we're going to project that out to the next 5 years. It's 2025, 2026, 2027, 2029, and then we're gonna find out an exit multiple, and then we're gonna how we calculate the exit multiple I'll come to in a second, because you see most of the places where an exit multiple is calculated using a comparable company. Now I don't really like that. Of course, for in industrial settings or in corporate settings, that is how it will work, because most of the times it'll be easier to do, or it'll just save you a lot of mind space. But what I like to do is, since I have no paucity of time, I just like to go and put in the geometric progression formula using the perpetual growth rate, and then that's how we get that, right? So what it's I'll just come to that in a second, but right now what I'm going to do is I'm going to fill out the EBIT, cash taxes, DNA, etc. Section, and then we're going to project that out to the next 5 years. Yeah, makes sense? Cool. Awesome. So you're gonna see a lot of tinkering between tabs here. I'm gonna first go with operating income for the most recent year. Do we have that? No. And so we're gonna have to look at a company's financial statements. I like Europe because it basically always, without, what's this? Yeah. I like Europe because it always discloses its financial statements upfront. Like it's the first few pages. So and if you get time, I'm gonna show you that. European companies are, I think, demanded to always show their financial statements the first thing, whereas US companies just will sparse that out somewhere in their disclosure, which I don't like, which is something that SEC should be taking care of, right? Because we just make it easier for investors. That's the whole point. Well, why would you make us awesome? Um, that was my rant, so just listen through it. This is what we need. We need income from operations, right? Operating income or EBIT. EBIT is basically earnings before interest and tax, and so as you can see here, it discloses its income from operations, then it deducts interest, then it deducts taxes. We're gonna go with 2024 first, which is 2023. So 8891 13656 and 6523. Okay, I'm gonna change this up real quick. 2019, 2020. So this should work now. Same thing here. Now the reason you're gonna see that I'm taking an year -1, so I'm taking 6 years for the net working capital is because we really want the change in NWC. And so how do we calculate that? We calculate that by taking the year previous NWC and then subtracting that from the present NWC. And so that's how we're going to get the change in net working capital. So for the net working capital, change in net working capital of 2019, we're going to need the data for 2018 as well to subtract that from 2019. So that's why we're going to take 2018. Let's now fill in the income taxes paid. So Tesla actually, that makes sense. Now Tesla had a negative tax rate, so it basically benefited from taxes. So what we're gonna do is, rather than making this a negative value, we're gonna take it a negative value, which is a positive. It's a cash taxes. The Tesla was actually refunded a lot of its taxes. I don't know refunded if it's the right word, but it was actually paid back a lot of its taxes that it paid in the years prior. So that makes sense. That is good for Tesla this year at least. We're gonna go with 1132, which is gonna be negative since it's an income tax paid. Right? We're going with 699. Cool. Makes sense. Let's now go with depreciation and amortization. There it goes. 4667. God, 3747. God, 2911. Right, property plant expend. I realize I've been calling it expenditure for this whole while and I know something was off. It's property, plant, and equipment. I apologize for that. Minus 8898. Minus 758. -6482. Yeah, so one of the last things I'm going to need from this year's financial statements is going to be the current assets and liabilities. So let's go to the balance sheet for that. You can need the current assets, which is 49616. We're going to subtract the current liabilities. We're going to add the previous year's assets first. That's that. 4917. Deduct the current liabilities. 28748 minus 28748. Why does it always have to be equal to sign, man? Minus, yeah, that makes sense. And then we're gonna go with minus 2619. Alright, so let me change that into accounting formats so that it does not, throw off the wrong idea. Awesome. Go 2021. Right, so, and the last thing we need from this year's financial statements is going to be its cash, so that we can deduct it later on from the enterprise value. Add that on to the enterprise value. Cash is basically going to be used to pay off all of its debts. And so we've got something interesting here. Okay. I see where I went wrong. I think rather than the total income taxes paid, we should have gone with cash paid during income taxes, right? Or is that wrong? Let me just think about that for a second. Right, that's it. No, we've got it right. Yeah, that's fine. We need the cash in hand at the end of the period, so we're gonna go with this value 17,189. And now we're done with this part of the disclosure, right? So we're done with this financial statement. Now let's move on to the last year's financial statements. Right, we need this to work. It is working. Let's go with the financial statements and supplementary data part of things. Found it. Let's just start with the current assets part of things. 27,100. We need to subtract the total liabilities from that. Total current liabilities 19,705. Subtract that rather. Current assets, it's 26,707. And then we can subtract total current liabilities from that. 14,248. Gonna look at 2020 values for property, plant, and equipment. Thank God I said that right. Yeah. 18,884. Oh, is that right? 12,747. Wait, something was wrong. How did that grow so much? This is the number. This is gonna be 3157, right? And then this is gonna be minus 1327. Makes sense. Depreciation and amortization is gonna be this value 2322, and 2154. We're gonna go with cash taxes next. This is 299 minus 292, and minus 292 minus 110. Let's go with EBIT, which is the operating income. $6,523,1994. Negative EBIT of minus 69. Now, if this sounds monotonous, it is because it is, but let's keep in mind that not everything in life has to be interesting, bro. Sorry for that. Okay, let's find out the total current liabilities for the previous year, and let's just get done with it quick. We'll get 12,103 and 10,667 negative. Minus 9,993. Yeah, and 8,307. Now, ideally that should have worked, but we've got a couple of errors, so let's fix that. This just come out of that. This also will just come out of that. Now, half the problems in this world would have been solved if people would just command our stuff. Because that's how you solve Excel problems, apparently. I'm gonna clear this section out because you don't need this. This is just for the present values. Why would you need that, right? And let's just put all of this in accounting format. Yeah, makes sense. And this is now bullshitting us the EBIT values. No. Okay, so let's just keep that at 10%. Now this is what I meant, right? So no company changes its EBIT values by 500% year on year, but it's been, I mean, Tesla's been doing that apparently. So I mean, why not? Let's just make that happen. Cash taxes 35% sounds good. DNA 17, but let's just make that 15. Property plant, I don't want that. Let's just keep it 25. Change in net working capital, let's just keep that 0. Now I know I just threw the Excel predictions out of the way, but that's because change in net working capital at a company like Tesla is not expected to change really that much, and so let's just not project that. PP&E, I'm fine with 25%, but we can keep it even lower. But let's just assume the worst case scenario. Exit value would be this. Now, is Tesla profitable? Nah, bro. Tesla is not profitable. So apparently, equity value for Tesla is very, very low, whereas the current share price is very, very high. So this is not the right investment, I believe. Yeah, I think we're done with that.